Okay, so you're a first-time home buyer. You're buying a home with less than 20% down, and you're trying to figure out the difference between the mortgage insurance for a conventional loan, which would be private mortgage insurance, and an FHA loan. So what are the key differences? Hey guys, it's Evan Swanson of Guild Mortgage here to give you a quick tutorial on what to consider. With an FHA loan, if a buyer has less than 10% down, that mortgage insurance premium on a monthly basis is permanent. As long as they have that loan, they're going to pay mortgage insurance. Now, with a conventional loan, the big advantage is there's more favorable requirements to have that private mortgage insurance terminated. Let me walk you through some of those details. Well, first off, this is all governed under the Home Buyer Protection Act, which was passed back in 1998. And what that act says is that when a home buyer who has a single family primary residence, as soon as the remaining loan balance hits 80% of the original purchase price, either because of natural amortization or because they made a lump sum payment, that mortgage insurance goes away immediately. Now, if the homebuyer forgets to ask for that mortgage insurance to be initiated at 80%, then the mortgage company is required to automatically remove the private mortgage insurance once it hits 78%. Now, most people are going to be looking at using the home's current value because homes, generally speaking, go up in value over time. Now, what those guidelines say is that if it's between the first 2 and 5 years of that loan being taken out, then the home buyer must show that they have a loan to value ratio of 75% or less. Once the loan's been at it for 5 years, then they can use an 80% threshold. Now, a few other things to keep in mind. That borrower must have no 30-day late payments in the most recent 12 months and no 60-day late payments in the most recent 24 months. They may have to show evidence of current value, and oftentimes they have to be able to demonstrate that there's no second mortgage secured against the property. So generally speaking, a conventional loan is going to have more favorable requirements to have that mortgage insurance terminated, but you still should be aware of what those requirements are. If you have any questions about your situation, contact us today.